Well, hello everybody. Thank you for watching part 2. I know that part 1 was a bit long, so hopefully I'll make it as quick as possible. This one, although we do have a lot of content to go through again. I hope you enjoyed part 1. If you haven't watched it yet, what are you doing here? Come on, get back, get yourself out of this video right now, and get and watch that 1 hour and 33-minute video as well. If you have, well done. You've gone through the first bit and the most, I think, the most complicated one. Now you know the principles. Now you do know some sort of indicators and a bit of chartism, like I like to call it. Okay, so shall we see what we got here for today's session? So agenda again. We have already done our part 1. The big thing that I wanted to come out of part 1 was the 3 types of market analysis, which we had the technical analysis, the fundamental analysis, and the sentiment analysis, and them 3 are going to be a big part of your strategy later in the future when we start building your strategy. Within this section, the second part of the video, we are going to learn chartism. Now, I know chartism has got nothing to do, I think, with charts. Actually, is an English movement or some sort of riots and sort of protests. But I like to call it chartism because I think us that we look at the markets and we look at the charts, we are chartists, like an artist, but for charts. And what is that? I think I found a nice definition here. So here we go. Chartist is actually a real word. Yeah, and he's in the real world as well. It's not invented. So he's a technical analyst, as a person who engages with technical analysis, especially professionally. I'm not professional though. We're not professional, but it doesn't matter. So yeah, we use the statistics to determine trends in security price as well. I mean, we just use the statistics and we use technical analysis within our charts, and we are chartists. There you go. So let's get back to this. Here we go. So what we're going to be learning on this one, then we're going to be learning at the beginning. Again, just start a bit simple, start a bit easy. We're going to be learning some types of charts. Then we're going to go for price smoothing, and we're going to talk about how cool the price smoothing is. And I might also show you a little strategy that you can put in place. And as simple as it sounds, you know, you might make some money even with that one. Then we're going to look at some common chart indicators. We have already looked at some in the previous video. We looked at the, I think we looked at the RSI, stochastics, and MACD, some oscillators there. We're going to expand on them a little bit more. Also, I like to look at some common patterns. Just rupture, change of trends, and some sort of continuation patterns as well. Then, as I promised, I do have a whole section dedicated to Elliott theory, although it might go as far quite fast once we get there, but you'll get the principles. And then finally we talk about some boring harmonic patterns, and I say boring because there are so many of them, and they're like species. They keep popping up everywhere, but we're going to look at the most common ones, and just as to how to identify them, what sort of stuff can we use there, and what happens after we found them. So yeah, we'll look at them a little bit, and then our next video is going to be about build up your strategy using all of these, but we'll look at that later on. Right. Before we get started, again, I have to put this in every video, my disclaimer. Again, any information found on this video is only for general advice only. It's not, I'm not telling you buy or sell right now. I'm just telling you on a personal experience and under my knowledge after 7 years trading with Forex. A bit of how do I read charts, how how do I see indicators, and what do I like of them, what I don't like of them. It's also good for you to see with a blank chart, where do I put things and where do I look put my eyes on, and all of that things really. So yeah, this is only advice. This is only for training purposes. Although you can later adjust it with your own money management, risk and reward, and risk management, and all of that. As I always say, don't trade with any money you can't afford to lose. And that's pretty much all. Just pause these page if you want. Read it carefully again. Again, if you read it back on the previous video, read it again, because it is important. It is important. Right, boring stuff out of the way. Let's get started with the first bit, which is type of Forex charts. So let's take a look at these three most popular types of charts. We've got three. We've got the line chart, the bar, and the candlestick chart. Now, I have to say, line and bars are pretty standard, pretty simple. But candlestick charts, there is books and books and more books and even more books about candlestick charts. So I'm only going to tell you sort of the basis. I'm not gonna expand on it, because you can find it everywhere. You just need to type it on Google and then just find some information there and read more a bit about candlesticks. However, let's have a look at some of them. Let's start by the line chart, as I think it's quite a good one. Not many people use it, but I think I found some good uses for that. Right, chartist definition, you can go. Thank you very much. There we go. So let's go to our website, CandleStickTrade.com. We've got a really nice chart here that we can pop out, and we can use this as a blank chart. It's beautifully clean, and then we can start messing up with it a little bit. Right, so let's take the scale off the place. So let's choose our line bar. Here we go. There we go. That is our line chart. The only thing that happens with lines is that line gets only drawn between close and close. So within every period, in this case every day, a dot gets drawn with the close, and then a line gets put in between the previous close from the previous session to the new close, and then that's how you create the line charts. It's pretty much like the charts you used to make in high school when you do your maths and all that boring stuff. You draw the little dots first with a pencil, then you draw the line with a pen, and then erase the pencil out, and you end up with a line that goes up and down. But this is pretty much the same. Now, applications for this type of charts, and why do I like to use them sometimes? I probably use it at the beginning of the week when I'm doing my analysis of the whole following week. And I use it to find support and resistance. It's pretty good to find support and resistance, because you can only see closing prices. You don't see spikes, you don't see any noise. It's very clean, very sleek, very nice. So it allows you to find support and resistance on an easy way. Now, if we don't remember what support and resistance is, I do urge you to go back to the Baby Pips school and go through it as soon as you can. Ooh, a bit of publicity there. Go to the school, click in the school, and then go through all of these again. As I said before, I'm going through all of it again. I keep doing it. I've done it 5 times already, and I love it. So yeah, go through the school again. I think it was in the kindergarten. There you go, types of charts. Actually, no, there you go. Support and resistance levels. So yeah, go through this bit again in the school, and I'm sure you'll find a lot more there. However, you're in luck. I'm going to talk a little bit about support and resistance. Resistance for the price is where in the upper level the price has not been able to break certain levels, certain I like to call it roofs. And I can show you these a bit easy if we start drawing some lines. So this is a daily chart of the euro dollar since February 2015. I would like to say since the beginning of 2015 up until today. And we're going to show you, let's just make a thick line so that we can make it a lot clearer. So that there is a pretty horizontal resistant line there. Why? Because the price has tried to break that level 3 times in the past, and it has not been able to do so. So that creates a resistance where the price cannot break that level up. And like I said in the previous video, investors boring. We like to go over and over and repeat things over and over again because it becomes more predictable and easy to trade and easy to make some money. So because we didn't broke it before, as soon as we approach that line, all investors start thinking about selling. And that's the idea of resistance. You think the price is not going to break, and if it do break, then you will have to think about going long if it's a resistance and going short if it's a support. Obviously, make sure that there is some sort of confirmation and there is not an actual closing over that, and it's a safe position to go to. But yeah, on the concept, that is a resistance. A support is exactly the opposite. It's where the price supports itself. So we've got another support here. Oh, I forgot that. We've got another support area there. There, here we go. So the price followed all the way down in a free fall until it found a level where it bounced right back up. And that level is pretty strong because the price, as soon as you touch that level, then it bounced up, and it has not been back until April, when it actually went over to this level and bounced back again. So then once you have 2 or more support areas, then you can draw a trend line there, and then you can see where the price will rest in the future if it does so. It not always do so, but again, investors are boring. They like to repeat things over. So if we were to see this price falling down until it touched this area, I would be entering long just to give it a go, unless it breaks the price within 1 day and it closes below. Then you will think, oh, wait a minute, it's broken the support line. It does have a lot of momentum, so let's start thinking about maybe going back short again. But yeah, on a nutshell, that's how it works. And now, more recently, and actually yesterday, we've created a new mini support area here again, and the price is very close again to support. So look, we do have 2 areas of support here, and we do have probably another area of resistance there with some sort of strength. And then you were just trying to trade within these lines. You wouldn't do anything new. You don't want to invent anything new. You want to do what everybody does, play safe and make your money in between these lines. New support and resistance levels gets created every single time, so you do have to watch the market. That's what it is. If you're a trader, you're here to watch the market, really. Okay, so that being said, this is the line chart, and it's good to find support and resistance levels, and also to draw some trend lines. If we change these now to the candlestick chart, you can see how the places where we've drawn the lines, they are really firm places, that are really clean places. You can see down here that the price is even broken a couple of times. You wanna make sure that you place your line where the price closed. No, you can eliminate, you can clean up the noise of these wicks here, like this, for example, this trend line. You can see a few wicks trying to penetrate that line. They couldn't. It's been bouncing. So there you go. You can see that the price has bounced up and down there. But that's why the line chart really helps you clean that noise. We don't really want that noise if you're trading. If you're trading very safe, you sort of cut down a little bit the chances of getting scared. And that's the line chart really. Not much to say about that one. If we go back to the next one, our bar chart. Let's load it up first. Here we go. So this is actually an American thing, and is very used in Wall Street and Standard & Poor's and sort of all the American stock markets. It's really good to show you as well momentum. Although I don't really personally trade much with it, but to show you how it works, let's do massive zoom in one of these lines, and then I can tell you how it works. I'm actually going to delete these lines, and then I'm going to load up my pen. Here we go. There you go. So let's see then how these works. Let's start by on these here. So let's say this is our starting point. I'm actually going to I want to do it in black. There you go. Right, so these left wing there, this is the starting point, this is the opening price, and because we're on a daily chart, that this is one day, this is another day, another day, another day. Every single bar is one day. So this is where we open the day. The highest point is the highest of the day, the highest that the price has ever been that day. Again, we've got the lowest point is the lowest that the price has ever been that day, and then we have the right wing here, that is where the price closed. Now, just by looking at these, you can see that this bar will represent the price starting like this, going up, going all the way down, then bouncing up a little bit and finishing. So there you go. That will be the actual travel of the price within that day. That would obviously be a bit extended. If we zoom out, we change to the 1 hour chart, you can probably see the price going in, going up, going down, and then finishing below. Then the next one is pretty much the same. So the price starts here, goes up a little bit, goes all the way down, bounces, and then it starts there, goes down a little bit, bounces all the way up, and then all the way down, and finish near the same level. So what you want to find with these sort of bars really is this. I know if you're religious, I know that what that looks like. It's dodgies, and we're going to look at dodgies when we look at in a minute, when we look at the candlesticks. But you want to find where the price is sort of undecisive. It doesn't know what to do. That one, for example, is pretty good. Price has come all the way up, all the way down. It's pretty much finished at the same level where it started. And on a normal situation, a normal trending market, that will tell you when the trend is about to flip. Like here, for example, if you got these all the way up here, suddenly you find that one there, you would expect these to start coming down straight away. In this case, it did play a little bit the market a little bit, and then it start falling down. But even if you place your sell order there, you're still making a few pips from the way down really. So that's what you want to find with bars. That's what you want to do really with that one. There we go. So let's start then. Let me take these off. There you go. So let's shall we look at the 1 hour chart, and then let's see if we can find any of them dodges at the end. There you go, that's one there. After the trend up, you've got another one there where you could maybe give you a false entry. And obviously, if you're in an uptrend, you want to find the red one. Otherwise, a green one doesn't mean anything. If you're in a downtrend, you want to find a green one, which I can't really find anyway. Well, you can see there, there's a couple of them. So that's pretty much how they work. Look at how beautiful is that, and that's really good as well to draw fractals, which are probably making a specific video for them kind of things. But fractals is, well, something is repetitive one after the other, and it's a very immediate thing. They create fractals, they create like mirror bits, and that's a beautiful one because you can see every time the green one gets shorter, but the red one's sort of interconnecting. It forms like a little flag in there. So that's what the bar chart is. Then we go. Our next one is our candlestick charts, and candlesticks are actually Japanese. Is a type of Japanese trading thing. It was, but the Japanese who were showing and trying to play with the market as well, trying to find new ways to show sentiment, to show emotions inside the actual price, the actual technical analysis, and that's why they created candles. Now there is probably I would say about more than 100 types of candles. Everyone has different definitions, has different things. I'm not really going to go into explaining every single one of them, but I am going to explain the 2 or 3 that you need to look for. And there is candlestick formations that we're going to look at later when we look at common patterns. But for now, let's sort of explain how candles work, and then we can do the same. We can look for a couple of different candles and show you what do they mean. Right, so if we start for let's just say here again, so we'll be back to the January number. Let me just get rid of these lines because it's starting to annoy me. That off, there we go. And let's get a pen again. Okay, so candle, and that's the was a really nice one, ranging really well. The idea of the candle is the opening of the candle, it depends on the color, and the closing of the candle depends on the color. It doesn't depend on whether it's on the left or the right like the bars, but it depends on the color. So green candles are obviously up, happy days. Red candles are down. Green candles, you want to go long, you want to buy. Red candles, you want to short, you want to sell. If you have a long position already open, you want to close it or sell positions if you see red candles coming up, and the opposite if you have a short position. So to sort of explain in a nutshell how the candles work, let's imagine the price opened at this level, right? So that, let's just say that's that level, and because it's a green candle, the price is gonna open below, so it's gonna open down. If it's a red candle, the price is gonna open at the top. What the price has done here is go through the wick first, and the wicks, these and that, the shadows of the candle, these are places where the candle has been, okay, within that period of time, but not within the difference between the previous candle and the next candle. And you can pretty much calculate these by the opening and close of the session, really. So if the candle has opened here today and it goes down the price, and then it goes all the way up, and then it goes down, and then it closes and it passes to the next one, right, like our American bars, the candle will be drawn. This will be the body of the candle, that will be the wick, that will be another wick, and it will be a green candle because we start at the bottom and we finish at the top. If it's a red candle, which is like we've got here, the price starts there at the top, it went up a little bit, and then it went all the way down to here, bounce it back a little bit, and finish there. And then that forms the same length of the candle like before, but red, because it's coming down. That is how candles work. That's it, you know. It's not really much story as how it works. Now, the theme of the candle is what are they telling you when you look at candles, and when you look at why are they forming in different ways? Well, just to sort of look at a few ones that we've got right in front of us right here. We've got big candles like that one here, but with very little width, very little shadows, and that just shows you that the market has moved up and down on a big range, but it hasn't bounced back the same day. It's not been much volatility, even though the candle is big, the range of the candle is big. It's moved a lot of pips that day. It doesn't really show you that the price has bounced, or there is a very big indecision at some point and the price returned back to another place. It's a clear and tidy movement of the price that day. In candles, when you see long shadows like that one, it means that even though the day has opened and it's been a big range of movement, probably that candle will be the same size as that green one there. The actual price is come back all the way near to the same place where we find the opening. So the price is open, it's gone up and down, and it's closed right at the side. So the body of the candle is really small compared with the wicks with shadows. And these candles mean indecision. The market hasn't really got a direction. It's been testing at certain levels. It's been testing them levels up here, down there, and it's not been able to find any sort of consistency in those levels. There aren't really any investors looking to continue with the movement of that price, and usually tell us that investors don't know what to do. They're a bit confused. They don't know exactly what's going on, or where. So there probably has to be some sort of waiting for news, waiting for something big to happen, waiting for some sort of fundamental news to come out, or waiting to test a very key level where a lot of investors think that a price is cheap or maybe too expensive. Like in the case of here of the 23rd of February, where we went from indecision candle to indecision candle. By the way, these are called dojis, and that is spelled D-O-J-I, doji. Loads of doji around here. We've got 1, 2, 3, a lot of indecision, investors not very sure what to do, and suddenly, you know, something happened in the market on the 24th, 25th of February, and we found this. This is called the harami, and that is called harami. Harami means a pregnant woman in Chinese, really, or Japanese, I think. But it's good because it means it's a very fat candle, and it shows you decision, and that's what you want to see with candles. It shows that the emotions of the traders that day, we were all going down. We were all thinking, you know, this is going down, and we're going to break the support level. There was a support level there, and we broke the support level with the candle. We thrived through the support level, and then there wasn't the indecision that day was minimal because investors wanted to do it. Investors wanted to do that. Then after that, 3 days after that, look, you know, it's been a bit of indecision. We don't know if the price is going to come back up here again, and then after a couple of days, seeing that the price is not going back to that level, then investors said, right, that's it, you know, price has not been able to go up. There is no way that this price is coming up again, because everybody thinks the price is of the euro in this case. Remember that we on euro dollar. The price of the euro at this time is very expensive. We have to sell some euros and buy some dollars, and then you find this drop here. So that's another type of way to look at candles. Another one for us here really will be something like this. This is the inverted hammer. Are they someone else that call it a pin bar? It's like that would mean indecision in the market, but it doesn't mean anything on its own if the following candle doesn't close above 50% of this candle above that level. If that candle would close above that level, you would think this was going to go up again. It didn't. Again, it didn't even test that level there. There was completely everybody knew what we were doing, and there were a big decision in the market to come down, and there you go. You got another couple of haramis there. Now, realistically, when you're looking at candles on their own, they do give you false entries. There's not really 100% guarantee that a doji would mean a reversal or that, or even a shooting star or something. I don't know, something that some candlestick pattern formation. It doesn't actually by themselves doesn't actually tell you anything, but it does give you a good indication at the beginning. And then when you find something within candles, then you can probably go out and look for other indicators to support what you're trying to find, or to support what the market is doing and where it's going. So you got big candles like this one here. They're usually made by either investors picking up their profits, or by just investors trying to test certain levels. You can see this level where we got the red line there. This level here was a very important level. We're trying to test it one and again and again and again. And even after some testing, some very intensive testing, them 3 days, we didn't know what to do. And then it came coming down. And then there you go. This is another of them ones there. But this time the price closed above the 50%. So there you go. We're going back up again for a couple of days. And then he touched that level again and back down until we find more indecision, and then more indecision. So yeah, I mean, that's how, in a nutshell, that's how it works. We could talk hours about candles, but we don't really have the time. And I mean, you can probably find a lot of information around candles and candle patterns and things like that. We'll want to look at some patterns later anyway, so don't worry too much about that right now. Right, so that for the types of charts. We'll look at the 3 types of charts now. So shall we see what's next? Right, so price smoothing. I like these. So what is a moving average? Now, you would have probably studied these in mathematics in high school as the mode, or sort of as something, as a trend really. The moving average is simply just a way to smooth out a series of data really. And what you want to do is you want to find the average data by summing all the data and divide it by the number of periods of data that you got, and then you get an average. So to be honest, a moving average is exactly the same that a normal average of any sort of data. It's just that it's moving. And it moves because when you tell the moving average to do an average over the past 10 periods, what it does is every time a new period comes over, it deletes the period number 1 at the beginning of the chain, and it adds the period 10 for today, and then it sort of goes like that. So he's always taking an average of the last 10 periods. But because the price moves, because we've got different days or different hours or different minutes, then he always takes that average from that period, and he writes the average as one price, and that price gets written with every period as well, and it gets put together in a line. That's as simple as that. Now, there is a couple of different types of moving average. We have the simple moving average, which is straightforward. is the period 1 plus period 2 plus period 3 plus period 4 plus period 5 divided by 5. That's it. And then we have the exponential moving average, which is actually slightly more complicated than the other one. Is what it does is it gives weight, so it gives more importance to one level against the previous levels. So it sort of makes the latest one a bit more important, a bit more it weights them a bit more, and when it divides, instead of divided by the number of periods, it sort of uses a calculation to give a bigger percentage to the latest period against the oldest one. That is on a very big nutshell, but I want to show you how they work out and how do we put them, which one are the common ones, and actually I'm going to show you one of the one of the mini strategies that you can use with a simple moving average, really. So back to our chart. Here we go, nicely one. We're going to add some moving average here. I'm going to add simple ones. We can look at the adding some more later. Some more. Here we go, moving average, and I'm actually going to add 2 of them. Now you can see the move there. Let me just get out of this. There you go. So we've got the first one, and because we're on a daily chart, the length of 9 means that this average is over the past 9 days. Okay, and it's taking the closing price of every single day to make an average of all of them. So it will be day 1 plus day 2 plus day 3 plus day 4 blah 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 until 9 divided by 9 days. But only the closing price. You can change these. You can choose the opening price. You can use the high, the low, depending on what you want to create your strategy on. I would use the closing one. I like the closing one. And now I'm going to put 8. And why 8? Well, because there is 8 days in a week. So by putting 8, these moving average is going to show me what is the weakest. The weakest, I will say the weekly average for that for every period, and how is that changing. And I'm gonna say this is the fast one. So this is a blue one, and I'm gonna give it a little bit of more volume there so that we can see it. Leave it on the scale right. You probably don't have that with your broker anyway. He's pretty much straightforward. There you go. So that's the first moving average. The second moving average, I want to put as 2 weeks, for example. And why I'm doing this? Well, I'm doing this because for us to use the moving average, we want to know whether the price of today is higher than the average price of the weekly or the last week, or whether this is higher or below the price of the last 2 weeks. And then obviously if the price of today is starting to accelerate, is starting to get closer to the price of the last 2 weeks in comparison with the price of last week, that just means that the trend is changing. You know, if you have this unlimited downward trend, for example, you would always have a parallel distance, and it's always going to be proportional between the 15-day average to, well, the 16-day average to the 8-day average, and it's always going to become it should be parallel and proportional, so they're always going to have the same distance. But if suddenly the prices start to accelerate, start to get closer to these averages, then that shows you, that indicates you that something is changing, and there is where you want to get in. That's what you want to look into. So let's just put this as 16 because I want to do it for 2 weeks, right? And let's just the style, let's just put it a bit thicker again, and this is going to be the red one. This is going to be sort of a red for me, just to know which one is the slowest, which one is the fastest. And then, I know this might sound a bit crazy, I'm going to hide the price. That's it. Bye bye with the price. I don't care about the price. And we end up with this. We end up with the actual average of the last of the week and the last 2 weeks of the price. What do you want to do here? well, you wanna buy and sell, well, buy or sell when they cross. So a really nice example would be, let me just pick the this again. So a really nice example would be this. Look, the fast moving average cross the slow moving average, and it crosses pointing up. So if it crosses pointing up, you want to buy. When do you close your position? Well, when it closes pointing down. Look, close pointing down. There you go. That's your trade. There you go. Now, yes, I know these. Well, you know, you're looking at this now and you're thinking, oh, come on, that doesn't work that way because the price is not really there. Prices might be shooting up, shooting down. We're going to look into that in a minute. But the principle of it is when they cross over, when the fastest moving average crosses a slow moving average, you want to operate in whatever direction that's closing. Now, that could have give you some wrong indications, some wrong trades here, for example, where the market was ranging and it was sort of consolidating from the big drop. It would probably have give you a very small trade here, not a very big one. It would give you a mildly good trade there again. It's not the best one, but you know, yeah, that was a good. And if we go back, I mean, you know, you would have signaled this amazing trade, and you know, look, so that it closes down, it closes down, it closes up, it closes down again, it closes up. So you know, if you're doing it and if you're using this method always, you would have 1, 2, probably that will be a fake buy, but then 3 sells, 4 sells, 5 sells in comparison with 2 bad trades. So at the end of the day, if you use money management and some risk and reward of let's say 2 to 1, because you're winning more times that you're losing anyway, you're still making money out of this strategy. So yes, you can use moving average this way. You can also use the moving average with the price, and I'm going to bring it back up again. So there you go. So price tend to use moving averages and as support and resistance. And the 2 moving averages that I've got on, they're quite fast. They're very close to the price, and it's difficult for you to actually get an idea looking at the daily price. But if we go to the 4-hour chart, for example, which is midway between the two, and then we change these, so we put the slower one is going to be 50 periods, so 50 periods of 4 hours, and the fast one, the slow one is going to be 100 periods. This is when things start being a bit smooth. Look the waves. They sort of well, it's smoothing the wave, isn't it? It's just trying to do that with it. But then price tend to use this line again as a very good. Where are you? There you go. As a very good support and resistance. So look, there's the resistance there, another resistance here, and every time the price cross one, it looks for the other one. So this is a good support there. When it crosses one and closes below, then it goes for the next one. And if it if it breaks both, then and it closes below, you want to sell. You know, you want to enter short. And the same, you know, if it does it up. So if it breaks the moving average up, it means that this price is higher than the last. The last 50 periods of 4 hours and the last 100 periods of 4 hours. So obviously, if it's like when you open your newspaper in the old times and you see that your bank in the stocks has been trading up now for the year, and suddenly within the last month or so, you keep seeing the price coming down and down and down. So you think, wait a minute, over the whole of last year the price has been going up, and now within the last month this price is coming down. So something is changing. And this is what you want to use moving averages for. You want to use them to identify whether the trend is changing. How? Well, if the moving average points down, the trend is usually started to change downwards, and if the price is below the moving average, then we're trending down. If the moving average is pointing up like this too, and the price is above the moving averages, then the price is trending up. That's it. That's pretty much how it works. And if we go backwards here, we can probably see very good examples. There you go. When the price has managed to break one, break two, and then use them as support. So he used them here as resistance a little bit, and then now he's using them as support, and then he bounces, and then he gives you a really good trade, and then you close your trade as soon as he touched the moving average again. And then he breaks the two, so you want to sell. Yeah, that's pretty much how it works, and he repeats again. Oh, another beautiful trade there. So yeah, I mean, it repeats and repeats and repeats, and in a trending market, they're awesome, because every time the price gets close to them, the price goes even further away, and with even more momentum, more power away from them in the trend direction. So you can see it here. As soon as the price gets close to them, boom! Because investors are looking at them and thinking, right, you know, it's getting closer to them. So again, you know, the price of the dollar keeps getting cheap. So I'm going to buy dollars with my euros and selling euros, and that's how moving averages work, pretty much. Okay, so next one in our lovely list is, well, I just put that as well. So SMA, the pros and cons of them, and you can pause these and read it slowly if you want to display smooth chart. Slow moving, which might cause a lag. EMAs, the exponential moving averages, the more prone to cause fake outs and give errant signals. So you can use double of them, you can use combinations, you can use pretty much whatever suits your need as a trader. Here we go. So let's start with some common chart indicators, and we're gonna visit all of these. You can pause these later as well. I've actually put here the parameters, the common parameters of these indicators, and then you can pause it, play with them as well. I do encourage you to put this in your chart and then just play with them. Just change the parameters, see how they work out. You know, you can pretty much do whatever you want with them. Let's start with the Bollinger Bands, and you think, what is this guy talking about? The Bollinger Bands, what's that? Right, so let's just load them up first. Let's just see if I can find them first. Here we go, Bollinger Bands, and this chart is quite pretty as well. So it's quite good to show you these bands, because they actually fill the space in between. Just to sort of explain what are they? Bollinger Bands. They're used to measure market volatility. Basically, the tool is telling you whether the market is very quiet, like, I don't know, like for example here, very quiet, or very, very loud, and the market suddenly explodes and goes very loud. So when they separate from each other, the market is really loud, there is a lot of volatility, and when the market gets a bit quiet, then they get together, they squeeze together, and you can probably see it better on a small time frames. You can see how they squeeze and then suddenly boom, you know, they open up, and then they squeeze again and they open up, and then they give you a drawing. Now you probably already starting to notice something just by looking at this. One thing that I want to say about Bollinger Bands is the price is not comfortable on the outside of these bands. It's not comfortable at all. It doesn't like it. It doesn't like it. It wants to come back home. And how does it do that? Well, it does that by returning to the center line. So you can use the Bollinger Bands in a different situation. You can establish when the market is quiet, and you might want to trade there, or you want to trade on the bounds of the bands between one and another. So if we want to trade within the bounds, we want to, well, we want to wait until the price touches one of the lines, because we know that most of the times the price wants to find the center, and this only works. I mean, this only works really well when a price is maybe ranging, or the market is quiet after all the news is passed during the day, and we've probably closed the London session and the American session, and we sort of in limbo there in between sessions. There is where you want to use Bollinger Bands if you want to do some scalping. Really, you want to do it between here and here where the market is quiet, and then you want to play with them a little bit, and having in consideration that the price wants to come back to the center. You want to place your sells within the upper line and place your buys, place your longs within the bottom line, thinking that the price is going to go back to the center line. You wanna close your position as soon as the price touches the center line. Now, this might give you a good trend. This might give you a good trade. It might give you a wrong entry. It depends on what you do. So you can see examples here where you would have bought. And then you would probably close your trade there, or maybe choose two different take profits, or even go safe and wait until the price touches through to the top, and you would have probably closed there. So it will give you a nice little trade there, a few pips. You want to sell when the price is up, and then take profits when the price touches the center. Or you wanna put your take profit 1 and take profit 2 at this level. You probably would have never touched the take profit 2. It would have been hovering over the take profit 1. You would have probably waited here because it's so tight, and that's probably because it's night time. There's nobody trading. It's only the high frequency traders open and doing their little numbers. But then when they start opening up, you think, oh, wait a minute, the market is coming back up, it's coming back to life. You can also use Bollinger Bands to trade on breaks, on breakouts, and this is one of the examples here. So when they get really fatter and one of the candles breaks the Bollinger Band and closes over, like this case closes over with this candle there, even though it sort of went down a little bit, you wanna trade on that. You wanna buy when it breaks. Now it's a lot more difficult to find your take profits there, because you have to just watch the market and see how it goes. You can't just put your take profit on the center line, because the center line will be down anyway. So if you're buying or selling on breaks, then you probably want to be in front of your computer and watching the market until it does something else. It does also give you pretty good entries. You can see here it broke the market down. Yeah, you probably get scared a bit here, but because you put you would have put your stop loss outside the cloud. A few pips outside the cloud, you wouldn't have touched that really if you would have done it properly, and then it would have come down. It's a decent trade there. So that's one way to trade. Another way is obviously between the bounce. So when it goes down, buy. When it touches the open, sell. But only if you do that, close your positions in the center line, because you never know whether it's going to go all the way back down. Like in this situation, you need a lot of volatility for that to happen, and sometimes you present it with this. And what do you do there? Well, you can't do anything. You pretty much have to wait for that to do. On bigger time frames, it might don't work as well. On the weekly one, it does work really well on the weekly one. Although you have to wait a few weeks to get your money, but if you're a long time trader, then you want to maybe give it a go and sell there. Look, it give you a really good entry there. Sell. Again, it's about to give you a couple of good sell with shorts there. It's back to the center line at the moment. The price always wants to find the center line. It's very comfortable there. That's home. sweet home. So that's pretty much Bollinger Bands. There's not really a big thing about it. They're pretty easy to use. They do give you some fake entries as well. So again, like all the indicators, you can't use them on their own, because if you give you 2 or 3 fake entries in a row, then you start feeling the pain, and you might think it doesn't work at all, when you just need a bit of confirmation, really. Okay, so next one in our list is the MACD, and I think we've touched on this on the previous video anyway, so I'm not gonna go into it too much. I'm just going to remind you, what it is really. And the MACD is an acronym for moving average, convergence, and divergences. So you pretty much look when the price is getting away from somewhere, from the middle place, which is converging, or diverging when it's getting closer. It's used to identify again moving averages. He uses moving average. These two are moving average. That's essentially there is a difference between two moving averages as well. So it's different between these two, just put on a different way. And the thing of it is, you have a number of periods that is used to calculate the fast moving average, which in this case is the blue one, is the K line. And then you have the other moving average, which is the slow one. And the same with this, the same thing with like what we looked before with smoothing. So you want to operate when the fast moving average crosses the slow one, and you want to operate in the direction where it closes. He pretty much uses the same. It's just that because of the convergences and divergences, you can use it on a way to find levels where the price has come down, but it's not been able to find any more power in that area. Like for example, these massive divergence here. And again, like I said in the other video, you want to have one pointing down and the other one pointing up, and that's the divergence you want to buy as soon as that breaks. There you go. So yeah, not going to get much into it. You already know a little bit of it. We explained in a previous video. I mean, if you do want to find more, again, go back to our Baby Pip school. You probably can find a lot more information there. And you can also probably find how to operate 100% of them. But yeah, again, if you look at it in the 30-minute charts, it will probably not give you as many entries. And you would have to. Oh, that's a good one as well. What it's just giving you now. Look. And look. So I'll be looking to buy it as soon as I see that. This is already giving you 3 bars up. That is already crossed here, and this is live time as well. So you would look to place your long there. Actually, here we go. There you go. And then you just hope. You put your stop loss down here, and then you put your take profit, whatever your ratio is. Probably will be about there. Probably take profit 1, take profit 2 for a short trade, and secure it. Get it in your pocket. Better in your pocket than in the broker's pocket. There you go. That's how you find opportunities with MACD. Let's take that off. So next one in our list is the stochastics. Again, I think we've already touched in a stochastic before anyway, so I'm not going to get much into it. It's another oscillator. It does show you between 0 and 100 where the market is overbought or oversold. And then you want to trade when either you enter these areas having crossed, or when when you're on the overbought, oversold areas, or when you're crossing the 50 line, which is the center line, which is like now. Look, we just crossed. We're on the 60 lines now. We've crossed down here. We give you an indicator entering up. You wanna buy now and sell when this is about there, and then you come back down. and actually a lot of investors are sort of looking at there and trying to play with it and trying to see. We see another doji there, which is sort of a bit of indecision in the market, although this is half an hour, so it's not really very powerful, but it does show you a little bit real time how does that look like. So that's a stochastic. We'll explain it before in the previous video. I'm not going to go through it again. RSI, Relative Strength Index, is quite a nice one as well. It does show you again, it's another oscillator. It does show you the same thing. It does show you when the market is overbought or oversold. It's just that it does that with one line, although you can put them together. It does only that with one line. Let me see where the R is. Relative Strength Index. Here we go. There you go. And a lot of traders are using this one because if we go on a 1 hour chart, you can tell the price never come out these two ranges, but when it does, it's certainly going to go back, no matter what. Because it's quite a good indicator to tell you that when the market has a lot of strength or it's losing its strength. Like this one, for example, is overall, and that would have been maybe a very mild trade. It wouldn't be a very good trade there. It will probably hit your stop loss down here. Although, you know, it doesn't always give you perfect entries, but that would be a perfect entry. That would be a really good entry after that gap. Again here, you sell there. It not only measures where the trend is going by the direction this is pointing up, but it also tells you what's the strength in the market by using a mathematical calculation, really. You can also modify it. You can modify the periods as well. You can tell that the higher the period there, the smooth that it's going to be, and the more difficult it's going to be for that to go in between the over the 70s or below the 30s point. So if you put, for example, 30 on the length, you can tell that's more difficult now for that to go. So you're sort of securing that if that comes in between these lines, you wanna open a trade like this, for example. Look, if the price ended up being so smooth, being so difficult to get out of here, when it does, you want to open a trade because you got more security again that's going to happen. I'm not looking at the prices now, but look, you know, it's difficult to find when it comes out. So there you go. That's another one there, a little bit. And if you look at the price up there, look, you know, you would have opened your trade there. It's a really nice sell. That's sort of another good one. It probably would take you to there. So you again, you know, depends on your risk and reward, and depends of how you trade and how much money you want to make. Then you would have probably closed that on a trailing stop. So yes, I mean, it does give you indications. It does give you signals, and the higher the period that you do, the more difficult that signal becomes to appear. If you do 100, then it's pretty much flat. You know, if that ever crosses up here with an 100 period, I go in with the whole of my accounts. You know, it's quite difficult for that to happen. So yeah, that's how you use RSIs. Really, it's exactly the same that the other oscillators just tell you strength, apart from telling you where the price is going. Right. So ADX, Average Directional Index. Now, AVX are quite they're quite exciting because they're not only, it's not only an oscillator anymore, it's also tells you where the direction is going, and if the direction of a trend is strong, weak, or by the way, I've jumped the parabolic side. I'll come back to that. Don't worry. I just spot that. That's why I was thinking at the same time I was speaking. I know, it's fine. So yeah, ADX, coming back to that one. Let's just put it on the chart, and then let's just discover what's that about. So average, I'm not going to have it here now. Average directional. Ah, there you go. It's called directional movement here for some reason. Right, that looks a bit confusing right now. As you can see, I'm going to put it back into our daily chart just to make it a bit clear. It does tell you whether the trend is strong or weak. Now, on this one, for example, it's got 3 lines now. To be honest, you would only have one with the ADX. This is just a fancier version because it tells you as well whether the trend is bearish, which is the red one, or bullish, which is the blue one. And this is sort of this is the ADX line, the middle one here, which is telling you how strong the trend is. So in this case here, just by looking at these and without actually looking at the charts, you can see that the bearish, there is a bearish trend, and this is quite strong because it's over, it's over the 20 line, so it's a very strong bearish. And the bullish trend, the trend for the bulls, the buying trend, the uptrend is very downwards. It doesn't really have much power. But then you want to trade with these when they cross, when the bullish trend crosses over and the bearish trend starts plotting down, and then you start seeing some strength in the market, which is this center line there. Let me try and find an actual with another chart. Maybe with this chart here. I was going to use this one later to explain Ichimoku. We'll come back to that anyway. We can forget about that one for now. Get the volumes off. Let's see if we can find these ADX here. Let's have a look. As you can see, I haven't actually prepared these, so I know I should have done that. There you go. Let's try and arm that one in. Well, look, fancy this one. Actually telling you where you've got well, I guess where you got a bullish and a bearish by changing the color. You wouldn't normally have that, but yeah, I mean you can get the idea. It does tells you where he wants to, where the trend is very strong or very weak. You consider weak trend when it's below 20, and you consider a very strong trend when it's above 100. That's where you wanna look really for confirmation to entry. As long as the trend is above the 50 line, which is the center, you can continue with your position open. You have a very good position to keep open anyway. Unlike the stochastic, ADX doesn't actually it determines it's not an oscillator like the other one. It doesn't go all the way up and all the way down and it goes into the minuses, and it goes it's over the 0 line, so it only shows as mountains rather than as an oscillator really. And it tells you where there is a very quiet marker. This is a 15-minute, but if we go to the 1 hour, then there you go, you got a market there. Even though the trend is bearish, it is not much power. The trend is just moving without actual volumes. It's just moving down the price because it's finding more offers below. Then the trend speeds up, and then when it crosses the line, the 100, it spikes up amazingly. And then it's usually I would only use the ADX just to confirm that there is a trend. That's it. I wouldn't actually use it to tell you whether it's bearish or bullish. I would more use it just to tell you that there is a trend, that something is trending when it's above the 100 line. That's it. You can see here nowadays between April and well, pretty much now, there is not really a trend. We're just ranging. We're just going up and down there. We're just in a range there because there isn't really a very clear trend until these actually crosses the 100 line and stays over. So, I mean, in a nutshell, that's pretty much how it works out. it only tells you where there is a trend. It doesn't actually tell you where the trend is going. And that's it. That's that one up. I should prepare that next time though. Right, coming back to parabolic SAR. Sorry about missing parabolic SAR. Some of you will probably kill me for that. Right, back to our price, and we want to use parabolic SAR. So until now, we'll look at indicators that they telling you where the trend is going, or whether there is a trend at all, or they tell you where to enter the trend, how to identify entry lines. But parabolic SAR is very good to tell you reversals. In fact, parabolic SAR, S-A-R, may actually means stop and reversal. So you want to use these to put your stop loss maybe above them lines, or to show you that there is maybe a reversal going on, and you have to think about opening the other way around. And let me just add one. Here we go. So how do you, you use parabolic SAR to put stop loss, but it's pretty simple. Put your stop loss above, or if you above if you're selling, and below if you're buying. But you can also identify a change in trend with 3 dots, and you will be like, what are you on about right now? Right, let me show you. Let's get again our drawing pen here, this time with a nice ellipse there. I think it's pretty cute. Right, so when you see 3 dots in the other direction is when you want to come out. So if we do amazing oscillators, you find an entry around here, and then you buy down there, you want to put your stop loss where? Well, you want to put your stop loss below the dots, wherever they are. You can see there is no dots here, so you might have found that trend a bit too early. So when do you find a trend reversing with parabolic SAR? When it's 3 dots. There you go. You've got 3 dots. First 3 dots in the downtrend. Below the price means an upper trend. And then if you would have bought here in that candle, well, you would have bought really in this candle here, because this is the 3rd one. So what have I done? Right, here we go. So you would have bought there in that candle. You place your buy. This is the worst of the buys. You can buy here, all around the place, and you would have put your stop loss below that dot. But there is 3 dots, and the price is above those 3 dots. So that means that the previous trend that was a downtrend is changed now. And then when do you wanna close that? When do you wanna take your profit? Well, whenever you see the next 3 dots, but this time above the price. So in that case, it would be there. Look, 3 dots above the price, and that would have probably been around here. And that's where you want to close. The worst that you could ever close your position would be that one there. So between these and that, that's 108.50, and that's 110.50 probably. You have 109.50 and 110.50. You have 200 pips there, which with one lot you wouldn't make a lot of money. Okay, you probably don't wait all the way until you find the 3 in a daily chart. You probably move your stop loss up and up and up just below these dots until suddenly you got your stop loss in one of these dots, and the price crosses, and then yes, you pick some more profits. But the idea is, in the worst of the situations, you wouldn't make a pretty decent one. And when do you open your? Well, when you could sell straight away here as well. You can see you got a couple of pips there as well. But if you're only looking for buys at this time, you wouldn't wait until the next 3 dots below the price. And there you go, 3 dots below the price, and you would have bought here. And then 3 dots above the price, that would have probably touched your stop loss there, and it would either break even, or if you have been moving your stop loss, or you put take profit near resistance, then you probably close it when the first dot appears. Then you get a bit scared and get out. But that's parabolics are. You can use it for a stop loss, and you can use it to find exits of trades. If you look in the 1 hour one, it's obviously a bit more practical. You can see the first 3 dots, and 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 then you can have a good idea of when the market is trading. Oh, look right now. So we have 2 dots there. We had a MACD before. It was showing us an entry signal for a long trade, and when we have the next dot here, you could enter long, put a small take profit because we're on a 1 hour, put like 20-30 pips, wait for that, put your stop loss down here, and you're about to make maybe a pretty good long trade out of that. This is obviously all speculative. This is technical, so it doesn't actually mean that suddenly someone will come out from a central bank will say something. I mean, I doubt it at this time, but someone would say something and suddenly blah, the price plummets again. But in a normal situation, and if you only use these with the balance of probabilities, you would have better, more good trades than worse trades, and even with certain risk and rewards ratios, you might even actually make money even if you have a negative balance of trades. So yeah, that's how it works. Okay, I left this one for the last one because it's quite tough. Ichimoku Kinko Hyo. Now, yes, you're still with me. We're still talking in English. You're not in a different planet. I haven't lost you. He's obviously a Japanese indicator. He uses. It tells you a lot of things in one. It's like WD-40. You can use it for a lot of different uses. But you always have one there and thereabouts. You always have one in your toolbox and another one in the car, because you can use it for so many things. So this is pretty much the same. It has a lot of indicators in the same indicator, and the idea is that with only one indicator you can trade. That's pretty much the idea. I guess there is going to be a lot of different versions of this one, like there is for everybody. You probably can find hundreds of thousands of different types of indicators, but this is how it looks loaded up, and I've changed the screen to the black one because it makes it a bit easier as well to identify. And there is a few lines in here, and I'm gonna go one by one, so just bear with me while I say these things. I know it might sound for you like a bit of an insult, or I might say something I shouldn't, but there you go. I'm a Spanish, so sorry about that. Okay, so the blue line is or called Kinju-san. It's called the standard line. It's a pretty much it's just an average. It's just an average of the last 26 periods. That blue line there. The Tenkan-sen line, which is the red line, it's also known as the turning line. This is like another averaging, but this moving average, it takes the highest highs and the lowest low for the past 9 periods. Which is a good indicator to show you when the market is trending, or when the market is flat, is ranging. Then we have the Chikou span, and that's the green line, and this is the important bit. This is the one. This line is called the lagging line, and it's basically today's close day plotted 26 periods behind. So whatever today's closing price is, but 26 periods behind. So 1, 2, 3, 4, 5, 6, 7, 26 behind there. And you'll see later why is that. Okay, then you have the Senko span, which is the orange lines, which in here there's one green and one red, which I'm actually going to change them because otherwise it's going to get confusing. So they're in here they're called lead lines. Oh, there you go. They're the orange lines, and the first Senko line is calculated by averaging the Tenkan Sen. It's calculated by averaging the red line, and the Kijun Sen, which is the second line, the top one here, is the same one but plotted 26 variance ahead of the first line. I know this is starting to sound a bit weird. So in between both, it creates the Ichimoku cloud, and this is used for support and resistance. When it's over the price is trending down and it's used as resistance. When it's below the price, like here, the price is trending up and it's used as support. But it's plotted in front of the price. It's plotted actually 26 periods in front of the price, so that you can see where the price could fall or could support it or could find a resistance later on. Okay, so how do you trade with these? And I know there's probably books and books about these, and I know it's the complicated ones. But let's just take it by part by part. If the price is above the Senko span, which is the orange lines, as I said before, you're trending up and you only place buy orders. If the price is below, then you're trending down. That forms a resistance, and you want to trade with the green line, with what's called the Chikou span. The green line needs to cross the price here, for example, and also the price needs to cross the cloud. So when you look at this one here, where the green line is crossing the cloud and the price is crossing the cloud as well together, and the red line is moving up, it's pointing up, and then it points up again, then you want to enter long, and you want to do the opposite when they close down. Now, on a ranging market, it's quite difficult to find entrance with this one, and even more on a daily rate. But if you go all the way down up here, where we had that one, look, we crossed that there, and the price bounce, and then suddenly down here crosses the cloud, pointing down. Then you have your confirmation with a few times this pointing down, and then you start placing sales orders. Now, the blue line, if the blue line is below the red line, is telling you that the price could continue to come down. If the blue line is above the red line, it just tells you that the price could continue to go up. That's it. It doesn't really have much story there. All while you have the blue line below the red line here, then the price could continue to come down as it did, and while that crosses, then you will probably take some money out of your trades and then just wait for a new entrance, or wait for that to touch the cloud and keep selling. Now, if we look these in a 1 hour chart, it would probably look a lot more chaotic, but it would give you a lot more of entrances. Again, green line crosses, you wait for the price to actually break through the cloud, and you would sell. While the blue line is below the red line, then the price could continue to come down, and once it touches the cloud through the top, that's a resistance level, you come out. So, I mean, yeah, it can give you a lot of fake entrance. It does have, because it has so many indicators within the same chart, it gets a bit confusing as well. So you might want to change the resolution of these, and you might want to change the colors. You might want to do a different thing. I mean, if we use one of my other examples, this this trader is quite good in the charts, because the Ichimoku clouds here actually change color when they are support resistance, so it gives you a better view of what's happening. If we go through the 4-hour charts, you can actually see, you know, a bit more visually that when it's time to sell, when it's time to buy, when it's time to start thinking about selling again, and yeah, I mean, you can use it in a very different ways, and I bet you that it's got to be 100 million different variations of this indicator. If we put here Ichimoku, we'll probably, there you go, an enhanced one. Look, that's see, that's what I mean. You know, you can find yourself different ways to color it up, and to find entrances, and to find other sort of visual indications to make it easy to see, make it easy to spot. I don't actually use these as much. I should do a little bit more, but I don't really like clotting my screen with indicators until the point where my screen can't really move properly. I like to have a very simple trade with simple lines, and just see where the key levels are. Maybe using some of the previous seen indicators, some of the number theories, and also, you know, using some Fibonacci together with other stuff. So yeah, I would only say this is maybe useful if you do it at a very small time frame. There you go, you can see short trades there, very snappy, very sort of easy to find, and it costs more time, so you probably do that on a 5-minute or 15-minute chart. But yeah, it's not really my style. I'm not saying it's not yours. Listen, you know, you can do it. It might be okay, but it's not my style. Okay, so after seeing the common chart indicators, jumping between them, I know, I'm sorry. You can pause this video now, and obviously they're the simple parameters. They're the rules as well. There you go. You can pause this out, and you can watch it if you want later on, or keep it on. Finally, let's get to the next one, and this is going to be a bit easy to do this. Not much to explain on these ones, but we're going to look at some common patterns within the candlesticks. And a very common one for reversal is the head and shoulders. Head and shoulders is nothing else but a head and shoulder. It's a head and two shoulders that you find within a price, and it does follow the principle of an M or a W, which we're going to see it later anyway in the harmonic patterns. But this is just with candlesticks, and it sort of shows you where there could be a reversal. And what we want to spot out of this one is the shoulder, the head, and the second shoulder, and then we have to wait for the price to break the neckline, which is that line there. Once the price breaks that and closes below, then you want to enter. If you find obviously this on a 5-minute chart, you have to be quick. And usually the movement that comes after it's broken the neckline is exactly the same movement, that distance between the top of the head and the neckline. So there you go, you can see it there. That distance is usually what you would take profit on this as it moves down. Let's find one in our chart. Let's just take the parabolic SAR out. So within the 1 hour chart, there was a couple of good examples before, a few days ago actually. There you go. Can you see it there? Yeah. Right, so if we can see it here, we have, let's just take there, that's one shoulder. That will be, let's take this away. That will be the head. I'm taking some noise away as well. And that will be the other shoulder. There you go. So that's the formation, even though it's pointing up, even though it's in an uptrend. That's a pretty good head and shoulder formation. And if we take this distance here between that and these, and we clone that line over, and we just plotted that line after the break, there you go, bingo. You will probably use a little bit less just to make sure you get your take profit, but there you go. That's a very good example, and this has not been prepared. You can trust me by how many mistakes I'm making, that this has not been prepared before. Another beautiful one is that one here, when we had the last the 5th of June of this year. We had the Federal Reserve sorry, the non-farm payrolls coming out. It was lovely, that candle there. So yeah, you can argue that fundamentals, that happened because of fundamentals, but yeah, that didn't happen because of fundamentals. That happened because of the bond yields, and that discounted pretty much the whole day. But if we plot here another head and shoulders, you can probably find one, then the head, and then yeah, we might have a very weird shoulder here, and then there you go. If we look the distance of that, and then we clone this line and we put this line below where the break, well, there you go. Yeah, beautiful. So it does work if you find them, and you find them in a good time frame. They do give you a really good indication. I think in the 4-hour one, I remember finding one for the upper trend, for the recent upper trend. I'm not sure if I remember where it was though. Yeah, probably. Oh yeah, oh there you go. It's massive actually. So there you go, that's one shoulder, that's the head, and that will be another shoulder here. Actually, that shoulder has not been completed. There you go. Yeah, I know, it is massive, and I'm not sure if this one gave you as much as the neckline. If we clone that and look at it in here, I wouldn't think it would give you that much though. But again, yeah, it's a good one to find. And if you do find them, like we're forming it now here, look, and this is we've been finding now a few indications that this price is gonna go up tomorrow. And it's about to form. Oh no, it's actually formed already, the neckline. So you're expecting that now to go up the same distance that the head, but in here on the next candle. There you go. So that's where you price expect to. It's actually a resistance from the 1st of July. So who knows? If you look for head and shoulders only, and you trade with that, and you look at the stochastics, and you look at the other indicators that we've seen, and they're all pointing on, why not? You give it a go. You put your stop loss down here somewhere, and then you just probably put there. This is actually giving you 100 pips, 1150. 1040 to 1150 is a bit more than 100 pips, but if you want to go short, maybe take let's just say, like, then you got a long position, and if you put your long position there, with a ratio, there you go, 1 to 7, let's just say 1 to 5, there you go. So that would be your long position. You stop there. You could only lose 1.5 times less than what you can win. So Why not? This is how we trade. This is how you trade. Looking at technicals. This is how you trade. You wait for all the indicators to point something, and then you go for it, and then wait for that to be completed. Okay, so that's head and shoulders. That's how you look head and shoulders. I'm actually going to close that. Ascending triangle. We actually have a massive one within the daily chart. We have a massive ascending triangle. I'm going to open another chart again, and then we've been within an ascending triangle since the beginning of the year. Actually, if you can see it here, we've got a pretty much horizontal line there doing resistances, and then we have these lines pointing up, and this keeps forming an ascending triangle there. So you would look for the price to break through the top before you buy. And I know this is obviously a daily chart. This is a very long one, but as you can see here, price has been unable to break the top level a few times, but it keeps doing high lows and is squeezing itself there. Then the price breaks the resistance and continue to move up later on. So you want to place your purchasing, your long trades after the price is closed over the resistance level. In this case, that will be a whole day over the resistance level. And then, even after that, look, it does a little gap there. It's showing you that there is a lot of strength, and it continues to go up. Right, so common patterns. And I want you to pause these for a minute, read it, because this is a few different patterns that we've got that I've collected for you. We've got reversal, bilateral, and continuation patterns. And I would only like to say reversal patterns are all the patterns that you find exhaustion, when the price gets exhausted from touching a couple of times or 3 times and doing a head and shoulders, or even through the bottom. A couple of times you touch and you're trying to test one level, one and again, and it's not being able to break it. Then that's not working. So there's nothing really there. There's no offers, or as you can say, as we talked in the first video, there's no supply or demand of that currency in them levels. So there's nothing stopping the currency going the other level. Continuation patterns are I like the flags. These things here that looks like a flag, or the bottom, the bearish flag. Actually, if you look at the bearish pennant, which I call it the bearish flag, if you go back to our euro dollar on the daily, well, this has all the points to be a very big bearish flag. Let me just extend that there, and let's just cut some lines there. So what do you think about this? If you look at these right now, right, and you look at how this is doing the zigzags there, you could say this is a bearish flag, could you? And if you look at our bearish flag down here, look, it looks exactly the same. So you would expect these to entry when the price breaks the flag. Up until now, it hasn't, so you wouldn't enter. We just wait for the price to break. Bilateral, these are symmetrical triangles where the price could either break up or break down. It doesn't really actually show you. And look, you've got a descending triangle as well, which is pretty much what we are now. But the only difference is that our triangle here is pointing up rather than point down, like the triangle in this page, which is actually pointing down. So I would say we're seeing more a bearish flag rather than an actual descending triangle there. These symmetrical triangles, we find them all the time within the euro dollar. In the 1 hour chart, you see them everywhere, and this is when there's been a big push, then it consolidates, and then it could break anywhere really. So what you want to do is just wait for that break. You would place your stop loss below the last time when it's not been able to break it, and then you would just leave the target run as fast as you can. Pause these, have a look at it, go to the chart, go to the euro dollar, find these patterns in the past, and look what's happened after that. You will pretty much find that it's always correct. Here we go. So Elliott wave theory, and now is when we get to the territory of the Elliott. And yes, I like Elliots. I do like to draw them quite a lot. I think they're quite pretty, and even though I'm going to show you later, there is 100 million different ways to find Elliots. There is actually very powerful Elliott wave, which is the 5-3 wave pattern, which is 5 waves going up in one direction or going down in the same direction, and then you have 3 corrective waves. You have 3 waves where the price has not been able to break anymore, and then it sort of stops and come back down. Now, just to give you a little bit of an insight, this comes from the 20s and the 30s when someone, I think it was called Ralph Elliott, he discovered, working in the stock markets, he discovered that even though it seems chaotic, there is always some repetitive cycles, which they point out the emotions of the investors. And again, we're coming back to emotions. We're coming back to how can we represent price with emotion, linking them together again, like the candlesticks does. So it's all about finding what investors are feeling and why are they feeling like that. Why they want to go buy or why they want to go sell. So as the best one to show you these is this wave, is the Elliott wave of 5 and 3, and is pretty much that. You have a first impulse where when investors have, for whatever reason, they have thought a price is cheap enough to buy it, and then they push up the price a little bit. And then they take profits. They take profits after that first, but they don't take as many profits as they've already if they're investing. They take profits of certain positions. Now, this is what you need to identify. This is usually at 38% of Fibonacci retractment. Usually, it could be a 50%. Might be on a 61%, although it's a lot less. It would sort of break the waves. It wouldn't really show you a very clear wave. But on the 38% Fibonacci, then you start thinking, oh, wait a minute, this is this is going up. When do you want to buy these? You want to buy on the break, and on the break of that level, which is actually here. Yes, I know you're losing some pips there, but you want to buy when the price breaks that level, because it's showing you there is a repetitive pattern here coming. So then from here is when you can be in front of the price rather than chasing the price. Then the price goes all the way up, and this third one is usually double the first line. This is where the price gets made, really. This is where the trend gets made. This is the strongest wave. Is because it's caught the attention of the investors. Like I said, you look at it, you say, oh, I mean, there's a wave here, and then everybody's just getting in. Everybody's getting in because they know there's going to be a cycle here that they can predict, and that's when it becomes massive. At the end of this wave, there is another retractive wave, the 4 wave, which again it should be 38% of the third impulse, because again, these massive investors, they're all picking up their profits. They're all closing some of the longs, and they're returning equity to their pockets and to their investors or whatever. And then they find themselves that, you know, he's making some profits there, but they know what's to come. They know that a last push, a last trial of these is going to come at some point. So what do? Well, they push it again, and this is when things start getting a bit silly. Wave 5 is the last wave, and it's when you start seeing them patterns on top of here. It's when you start seeing them dodgies and them like exhausted patterns, or maybe a head and shoulders, maybe a double. That looks like another thing. Maybe a double roof, maybe touching like a support, resistance. So it's when you start feeling, oh, this is not going anywhere. You know, this is a bit, and usually there is a rejection of that level. And now I've put these three lines a bit separate, a bit structured, but usually this A line here is right afterwards. It sort of like it goes up and then it comes back down straight away. There is a rejection of the level there. So it's then when you think, now it's time. If I enter here, now it's time to get out. Now it's time to close my position. And when you do that, everybody does exactly the same. And what happens? Price come down. Then when the price come down, this here is purely a testing line. The B line is purely to test whether there is a possibility to find more investors, where there is new investors that think this is a number 2 here, but it doesn't work, because if they found these 5 lines, no one is going to enter. In fact, as soon as that happens, you would find another set of patterns here, like more dodgies and more stuff, and then you would come out, and people down here would start coming out, and this is when the price starts falling. Which actually, this could be wave 1 of the downtrend, and then that could be wave 2 and wave 3, and then again and again and again. So that is the theory. That is the theory, and as I can show you my next chart here, you have waves, different zigzags, triangles and flat waves, that is showing you that a trend is getting exhausted here. This is what I mean when I mean before you find things. But then you also find waves within the waves, and this is when things start getting complicated with Elliott theory. You've got the 1, 2, 3, 4, 5, and then the ABC, and then the 1, 2, 3, 4, 5 ABC, and then you have the 1, 2, 3, 4, 5 ABC. So yes, you know, you can find as many waves inside the main wave as you want. That's the complicated bit. You never know where you are. You never know if you are, unless you find the big ones and then you break them down. One thing that I want to tell you is go to this website, ElliottWave.net educational, and this here you can find a lot of details about Elliott, the theory of Elliott, and this, I think this is really useful. That there you can find the super cycles, the cycles, primary, intermediate, minute. You can find the degrees of the waves inside here. You can read a hell of a lot about these, and you know, I wouldn't really become too bogged into these. I would just understand the basics, and that's about really, because you don't really need all of that to trade. You know, you don't really need all the knowledge to trade. You only need a little bit, and if you're looking into it too much, you might become you might not be able even to trade it properly. So yeah, you know, look at it with a good eye. Know about it, because you have to know about it, but don't become too bogged about it, because it doesn't make sense. Let's just find some waves here. So 1, and I'm just doing these over the way. I haven't prepared these actually. That's the wave 2. Wave 3 is the big one. 4, another retractment, and wave 5. Here we go. So that's 5 waves there. This is starting to be a bit exhausting, my computer now. There you go. And then you have the retractment waves. Oh, here we go. Correction. Then you have one, which he actually did a double top there, but I'm only going to count in that as one wave. A, B, and C. Here we go. So I actually found a good example there. So 5 waves down, retractment, and then what we got here, well, we don't know. We don't know until we find a couple of clear waves, and at the moment there aren't any. So yeah, that could be more correction, consolidation of the same waves, and then we could have another wave up, or even clone the same wave down, and then send this back to the 70p level, and you know, send these to prehistoric levels of the euro dollar. So yeah, that's in a nutshell Elliott theories. I did say that I was going to talk about them on their own. And then we need to move on because this video is getting too long again, and everybody's going to get bored again of me. Okay, harmonic price patterns. I'll probably talk about these in the next video anyway, but I'm going to show you. We're going to go through them in the next video as part of the third video, even though I haven't really put this inside the actual third video, but the third video is going to be very thin with building your strategy. So we're going to talk about these and the Gatlys and bats later on in the third video, which is actually them ones, the bullish Gatlys. They're all done with Fibonacci, so don't worry about them. You know, they're quite easy to find. You just need to find the main tops and bottoms. But yeah, we're going to talk about these later on. And again, thank you for watching. I know this video has been a bit long than I expected again, but I hope you like it, and I also hope that you have learned a little bit about indicators and other chartism, like I like to say it. Again, you know, huge thank for these. It is costing a little bit of time, but don't worry, we'll get there. Please do visit these websites, and no, I don't get paid anything, but you know, they are quite good. This is where I've learned everything that I know, apart from just experiencing it as well. Visit us as well in CandleStickTrade.com. Come to the chart, challenge me if you want to, tell me that I'm wrong. I'm happy to hear that. I'm not always right, and let's start some discussions. Let's share our charts as well. Show me what you've done. I've already seen a couple of very good examples after the first video, so I'm really proud of you guys. And also, you've got my Twitter there, SolidSnakeUK89. I post all sort of stuff, so yeah, why not get on board, get sharing, follow me, follow the community, and let's make some money. Thank you very much. Bye bye.